The January trading frenzy of certain stocks has come under intense scrutiny as legislators, regulators, and others try to understand what drove the rapid rise and fall of these securities. GameStop shares in particular surged from about $20 to $483 over 2 weeks in January. The price has since fallen to around $45. The Securities and Exchange Commission is reviewing the volatility. The Department of Justice has launched a probe, and the Commodity Futures Trading Commission has opened a preliminary investigation into certain circumstances of the rally. Also, the House Financial Services Committee is reviewing if the actions of brokerages and online communities require more oversight. Central to these lines of inquiry are questions of market manipulation and the actions brokerages took in response to the rally. But understanding whether these actions cross the line takes time and isn't always easy to determine.
Market manipulation, in a nutshell, is a scheme to create some kind of an artificial price. So you can do that different ways. There are different tactics that traders can use to try to artificially pump up the price of the stock and then benefit by selling into this sort of frenzy that they've created.
Dave Michaels covers white-collar crime and financial enforcement for the Wall Street Journal and says market manipulation schemes have been going on as long as there's been a market.
Some are quite time-tested, meaning they've been going on for a long time, and regulators know the recipe and they know sort of the telltale signs.
A well-known example of market manipulation is the Stratton-Oakmont pump and dump scheme of the early 90s, dramatized in the movie The Wolf of Wall Street. It involved convincing investors to bet large sums of money on a stock, inflating the price before Stratton brokers sold shares held by the firm and its partners.
What this trade will do is serve as a benchmark for future business, Kevin.
Do you feel comfortable with me now, Scott?
Carrie Curtis Axel is a former assistant U.S. attorney and former staff attorney at the SEC.
Your typical market manipulation case involves false statements by people who somehow want to manipulate the stock price for their own gain. That's your typical kind of pump and dump scheme.
These false statements can come in the form of brokers pushing inflated financial outlooks or bad actors publishing press releases with outlandish claims of business breakthroughs. Some commentators have said individuals coordinating on Reddit, largely in the Wall Street Bets forum, openly engaged in a pump and dump scheme to inflate the price of GameStop and other securities. These allegations have not come from regulators or law enforcement. The CFTC is looking into whether misconduct occurred as Reddit traders targeted silver futures and the largest exchange-traded fund tied to silver, the iShares Silver Trust. But in an anonymous public forum like Reddit, determining the identity of users and whether their posts were intended to deceive others may not be so clear-cut.
The SEC is a law enforcement agency, and it can seek records from Reddit that would reveal the people behind these usernames. They would do that by sending a subpoena for records to Reddit, and Reddit could agree to comply with the subpoena and just hand the records over. On the other hand, there are some limitations that the SEC places, frankly, on itself in terms of subpoenaing news agencies or news media. And one question may be, is Reddit sort of operating in a sense as a news site? And could it put up a First Amendment argument against the subpoena?
Actions taken by brokerages have also caught the attention of regulators. The SEC's acting chair, Allison Lee, told NPR that the agency is also looking into whether decisions to curb trading at the peak of the frenzy complied with regulations.
And specifically, it's looking at the reasons that the brokers gave. So, it wants to kick the tires on these explanations and make sure that they're true. When volatility goes up, clearinghouses, which are an organization that they collectively share the risk of trades defaulting or not happening in the stock market, those clearinghouses said to the brokers, you need to give us more cash to cover the risk. Some of these brokers couldn't immediately provide all the cash that the clearinghouse wanted. And so the only way to limit that call for cash or margin call was to limit new purchases of GameStop.
Federal prosecutors have subpoenaed information from brokers such as Robinhood, and the brokerage is facing more than 30 civil lawsuits in relation to the trading restrictions.
I am sure that the SEC and FINRA will be going through their rule books to determine if there were violations of the rules. Of course, broker-dealers such as Robinhood are claiming that the very reason they had to halt trading was to comply with the SEC rules. So they may have a very good defense that what they did was within their customer agreements that allows them to stop trading for any reason.
Experts say the outcomes of these investigations are not likely to come soon, but the influence of social media communities adds a new dimension to trading that will likely receive more scrutiny.
There's going to be this initial flurry of activity. Congress will hold hearings. They will want to assuage the public by taking some initial testimony and looking like they're doing something. But the hard work of making any change in this area will likely take some time.
At least through the lens of GameStop, it seems like social media is becoming a bigger influencer of investment decision. That does change how markets behave, at least occasionally, at least with respect to certain stocks. It's not something that they can completely ignore.